Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Welcome and hello. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or on any related items on these, my charts. This was all my own original work, so I think you deserve to have that. And so with that, Chicago soybeans, 21 weeks ago, I highlighted a bright pink July 24 to date rectangle pattern, currently 958 to 1099. This pattern is still operational even now, and we are now starting to approach the lower pink trend line. Nearer term, the market over late April and early May had tried to stabilize over the November 2020 low at 1045 and looked for a while like it might try higher. But over mid-May and then mid-June, we could see a capping action symbolized by the bright red, fairly flattish upper trend line on my daily chart, currently at 1084, which ended up being a May to June based double top. That's the upper trend line. More on this shortly. At the same time, the bases of the very recent action since late April also lined up into a lower trend line, currently at 1003. Together they made up an expanding wedge pattern that 2 weeks ago breached on the downside. It took a while, but it seems prices have now stabilized below the April low at 985. Now 3 weeks ago I commented on this thus, and I quote, "So whilst it is a bit early, I still thought it appropriate to set up some potential targets below for the bright red expanding wedge pattern. Thus a primary target X would be in the 991 zone, tying in with the lows of March and April, whilst a secondary harder to reach target X1 would be down in the 944 zone, tying in with the September 2020 low at 942 and the August last year low at 940, end of quote. 2 weeks ago, prices reached target X down in the 991 zone, as well as the primary target for the earlier mentioned double top at 994. However, the market then pulled up away from target X once it was achieved and back up over the bright red lower trend line. And for a short while, it looked like that might have been it on the downside. However, as I said 2 weeks ago, and I quote, "I would also keep a wary eye topside on the long moving average, currently at 1026, end of quote. And that proved to be true as this capped the rise and started prices heading lower again, down to new lows not seen since December last year. Now, we also still have target X2 at 970 below, the secondary and harder to achieve target for the double top pattern. Expected is seemingly not that hard to reach, as we just basically reached it whilst I was writing this. And it's basically because prices continue to move lower. I'll finally note the dead cross as we just managed of the short medium moving average, currently at 1033, heading down through the declining medium moving average, currently 1035. This is a lagging indicator, but it's still an indicator nevertheless. Chicago soybean meal. 16 weeks ago I linked some of the recent highs into a bright red downtrend, currently at 284.90. That tied in nicely back then for a while with the descending long moving average, currently 297.10. The long moving average was then just about shadowing the downtrend, but a little higher up, along with the medium moving average, currently at 291.70, which earlier had failed to provide much resistance above, but then energized itself as a resistance, and quite a good one, over mid-May to mid-June. Despite 10 weeks ago closes above this bright red trend line, those proved to be a false break high. It was only in late June with a clear break below the next drawn trend line, and that's the purple lower trend line, currently at 282, of what together made a descending triangle, later morphing into a descending wedge pattern, that we finally had a break, and it was lower. However, it took two separate goes at retesting back up towards the lower purple trend line, now teamed up with resistance from the August 2020 low at 281.90 to affirm the final move lower and set up the opportunity for the whole early June to date action being a possible bearish halfway hesitation. All this was enough for me 4 weeks ago to set out some possible targets below for both a descending triangle and a descending wedge pattern on the downside. Thus, for the descending triangle pattern, we had a primary target in the 273.20 zone with our secondary hard to reach target X down at 255.60, and that one is still live. For the descending wedge pattern, we had a primary target down in the 272.30 zone with a harder to reach secondary target X1 down in the 242.80 zone, and that is also still live. As you can see, both primary targets for the descending triangle pattern and the descending wedge pattern have been achieved, just leaving the harder, in some cases much harder to reach secondary targets further down. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates down to 2025. And that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've highlighted now for, let me just guess it, 112? Yeah, it's 112 weeks, so it's well over 2 years. And I quote, "I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to make that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we have been living in the shadow of this pattern ever since," end of quote. I've also added ever since, and I quote, "If there's only one thing you take away from any of my musics, let it have been those words," end of quote. These last few weeks have shown that the shadow cast but that supremely significant pattern so long ago still darkens the skyline of the market today. Chicago soybean oil. 6 weeks ago, we had a gapping move higher that punched up and out of the earlier showrunner here, which is the shallow bullish shift pitch hook of the mid-September to late December 2024 move. 5 weeks ago, we stabilized over the upper tine, and 4 weeks ago, prices pushed higher over the 50% Fibonacci line of the March 20 to April 22 move at 53.59, a small gapping move higher since filled in. Prices utilized the 50% Fibonacci line at 53.59 as a base for the move higher. This 50% Fibonacci line is quite interesting as it is the gateway to overhead congestion that stretches from 56.34 till at least the top of my daily chart in the 59.44 area. All this action had earlier caused a monthly key reversal up here for June. This leads me to what may be the most dominant pattern here right now, and one I mentioned 7 weeks ago. It was, as I said at the time, and I quote, "A new pattern emerged over the last month or so, and one I warned may kick off 2 weeks ago." So that's now 9 weeks ago. And I carry on quoting, and has actually done so since, though the break has not fully stabilized as yet. It is the dark blue start of April to end of May ascending wedge pattern, and that's currently 50.98 to 59.20. This pattern has the appropriate number of touches on each side, and back late 9 weeks ago had a brilliant breach and break lower. But as I said 8 weeks ago, and I quote, "Clear consecutive closes below this dark blue lower trend line, and I would feel obliged to lay out some potentials and even possible targets below for this pattern, something I'm not confident in doing just yet, but as I fear a possible false break lower," end of quote. Now, only starting now. Since then, prices have repaired itself. This pattern has repaired itself, and we are back well within, climbing higher over June's monthly key reversal up. Thus, we are only starting, I hasten to add, starting to enter the overhead congestion stretching from 56.34 to 59.44, and already trying to erode the bullish incentive. Now, there is one other feature I'd like to draw your attention to, is to look at the possibility that the lows of April and June can come together to form a new lower trend line, currently at 47.71, highlighted in bright green on my daily chart. A new lower trend line to the idea as yet, but I do feel obliged to lodge it in both your mind and in my mind, just in case.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.